money makes money, and the money that makes money makes money. You've got more time than you think. If you're compounding over 20 years, or hoping to wait 6 months because you just need a bit more time to really make sure through the actions that you see of that management team that they really are aligned with you through actions, not just words, is really important.
Have you ever wondered why some equities get that special tag of quality compounder? It sounds easy when you read about Charlie Munger or Nick Sleep buying Costco and holding it forever. But everyone knows the Costco story and how great it is. We can buy that great business, but we risk paying the wrong price. So what enables such businesses to compound? How can we identify these critical characteristics and so improve our odds of buying them at a fair or even low valuation? I recently had the chance to speak with two high-calibre professional investors who are passionate about doing just this. They spend their time searching the UK market for precisely these situations. These two highly experienced UK equity specialists started their careers in the 1990s at what was then Mercury Asset Management and is today BlackRock. Simon Young, among other things, writes the Curious Compounder Substack, and Mark Wharrier has a varied portfolio, including co-hosting the excellent Business Case podcast, and is a colleague of mine on the investment committee at Onward Opportunities. In this episode, we discuss Wise and Goodwin as examples of how very different businesses can compound growth. They share key characteristics, such as high return on capital, growth capacity, and duration. Very often, these businesses are founder-led or family-owned and therefore have the ability to pivot when circumstances change and take a considered long-term view about investing. We also discuss acquisitional compound growth, typified by UK-listed companies such as Halma and Diploma, or North American-listed Constellation Software. These companies derive their compounding from making serial acquisitions funded from internally generated cash flows. Finally, we discussed those companies that might earn the serial compounder tag in years to come. As always, none of what you are about to hear is any type of advice, but just for your information and hopefully entertainment. Please take personal financial advice before investing a penny of your money in these crazy markets. With that said, please enjoy my conversation with Mark Wharrier and Simon Young.
Brought to you by Progressive Equity.
So, guys, can we just start with you both just giving us some background on your illustrious investment careers and the main influences that have been on your investment philosophy? Can we start with you, Simon?
Mark and I both joined Mercury Asset Management back in the day. I joined in September 97. Mark, what about you?
Yeah, I joined 94.
He was someone I quite literally looked up to, both as someone who is about a foot taller than me, and then also because he was 3 or 4 years older than me on the graduate scheme. But it was an amazing place to start work, and it taught, well, certainly me, and I'm sure Mark, a hell of a lot about companies, about getting deep into the back areas of recesses of annual reports, and a love for shares.
That's absolutely right, Simon. It was a great place to learn, Mercury, but it was quite a Darwinian place. It almost represented the market itself because they were all fund managers had lots of different styles. So, you weren't just learning from one textbook. It was a great place to evolve your own style over time, I think.
As someone working on the sell side at that time, going and visiting Mercury Asset Management with an analyst or with a company, it was literally like visiting fund management royalty.
I think we were the page boys.
I just remember it was a place where you were given responsibility very early. I was there for about 18 months, and then somebody went on maternity leave, and they said, oh, well, here's £300 million of portfolios to manage. And it was obviously something that would never happen now. But in a way, it's a shame, right? Because I think there are people sort of choose investment as a career, or they have a real passion for it. And I think when people have a real passion for it, you want to give them responsibility as early as you can. because in many ways, that's when you're at your freshest and you've got lots of energy and enthusiasm, and you form views based on what you see in front of you rather than through biases that you pick up along the way.
Turning points in markets, financial markets and economies really are seminal times to learn your trade. And I think to have a library of that upstairs in your brain is really important. I think I've made a lot better decisions as a fund manager the older I get. I make less of them, as in I trade less, but I make better decisions, I think.
I think the earlier that you can start, the better, really.
I think that's an interesting jumping off point of what I want to come on and talk about. Not all companies are alike. In fact, very often they're very different, and some of them are very, very different. And you get this sort of power law that operates in markets and the ability to compound growth rather than just be a cheap asset relative to something else. This is what I really wanted to sort of get into, and understanding what is a compounding equity and how we can go about systematically finding them, or what are the best ways of identifying them, and once you've got them, holding on to them.
Think about what drives a share price. At its very basic level, it's three factors, right? It's return on capital, it's growth, and it's duration. Most companies have at least one of those in their favor. The special ones have all three. But I think it's not automatic, right? Because companies operate in a market economy. They have to be relevant and reinvent and self-disrupt. So the compounders that I admire and the companies over time have been those that have got that ability to keep going and to reinvent and not just be a stuck record. You think of a company like Next, which I know is kind of in the pantheon of sort of UK compounders. 30 years ago, that was just a high street retail chain operating in a horribly competitive clothing market. But you had inspirational management, had the ability to follow the money, pivot, invest, open up new revenue streams. That doesn't happen by accident. It's down to capable management team with the right incentives and who have got the oxygen to invest and think long term.
As Mark said, in terms of think about what is compounding, what are we referring to here? It's the ability to grow shareholders' capital over time at a relatively high rate, say above 10% per annum. And what do you need, as Mark said, to do that? You need a durable business model, because we're talking in years and often 10 or 20 years for real compounding. It doesn't need huge amounts of capital to grow. So that was Mark's point about return on capital employed, which allows that company to reinvest its profits back into growing the business. And if you think about UK long-term returns, so the UK has returned about 6.5% per annum over the last 20 years in nominal terms. So when we're thinking about compounders, we're thinking about these companies that can grow well in excess of that, somewhere north of 10% per annum. I think it's quite interesting just to go on to about how the brain struggles to deal with compounding. It's something that's pretty difficult. The human brain tends to work in straight lines. It has a series of heuristics or shortcuts that help individuals to solve problems, but it struggles with the exponential growth that happens with compounding. And I'll give you an example. So if you take a company that can earn a 20% return on its capital each year, and is able to keep all that money and doesn't pay a dividend and reinvests all the money, at the end of year one, it'll be worth 120. And then if it grows another 20% on top of that 120, it will keep growing. So at the end of 10 years, the numbers are quite interesting. But if you said to someone, okay, 20% per annum for 10 years, they'd probably go, well, start with 100, you earn 20% per annum. So that's probably worth 300. And the answer is no, it's 619. 60% of the return that you earn comes from the interest on the interest, And this is what Einstein referred to as compounding as the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. And another great Benjamin Franklin comment, which was, money makes money, and the money that makes money makes money.
Yes, that is the essence, isn't it? And our brains can't really get around that, however much we think we can, and however much we tell ourselves these heuristics, we still seem to be surprised by it. Now, I've got a little brain tease for you. I think it does relate to the point. So the difference between $1 billion and $1 trillion, okay, the starting point to plant the flag in your brain is that 1 billion seconds ago was approximately 1991, a year we can all remember. When was 1 trillion seconds ago? 1 trillion seconds ago was 30,000 years BC.
There we go.
Because we think in terms of it being, the relationship is linear, but it's not.
Yeah, it's exponential.
Yeah, do the maths. So really, we want to catch these sort of tigers by the tail. And I don't know, you started writing about it on Substack, Simon. Your initial 2 companies that you've written about in The Curious Compounder were, on the surface, companies that bore no relationship to each other at all. You couldn't imagine 2 more different companies than Wise and Goodwin, but those are the 2 you chose. So this is why I think it's sort of interesting to talk about, because you can find this effect in some very different places.
Yeah, I think it's about keeping your eyes open. And half the time it's about, you look at Peter Lynch, invest in what you know. Some changes in the budget meant that my full-time job at Foresight went to a part-time job, which has allowed me to express my opinions the rest of the time, writing some, I hope, interesting deep dives into companies. And a company that I've used its product and really liked is Wise PLC. So I decided to write about it. And the more I was looking into it, and I must admit I'm a shareholder now, the more I liked about the flywheel that it was creating in terms of low-cost product in financial services, which they reinvest as they win more clients, and their infrastructure allows them to lower the costs to themselves. They pass that back to customers, thereby increasing their moat. It's a money transfer business. It allows companies and individuals to transfer money internationally at very low commission rates, and it's very fast as well. So you put that together, you transfer money to Europe and it'll cost you, 30 basis points, and it'll be done at literally 65% of it is instantly transferred and 95% is under 24 hours. And it does that for 30 or 40 basis points. Whereas you compare that to the high street, which uses SWIFT, which is pretty much a misnomer. It may take a day or 2 and charges, let's say, 3 to 5% compared to that 30 or 40 basis points for Wise. So it's a huge profit center for banks. They have no real incentive to disrupt themselves. Wise is taking them on and winning. It's now got 16 million customers. It's layering on different services and it continues to grow. And it's that classic sort of Amazonian, Costco, Ryanair. The more we win, the more we lower our costs, the more
you win.
Exactly. Now with that few £100 in your bank account,
I could switch it into crypto assets or something, can't I?
Yeah, exactly. You can turn on interest. So they're paying 3.5% on UK balances. They're paying 3.9% on US balances, 1.7% on European balances. And so roughly they've now got £23 billion of client money, which is within their assets area, which is earning money, which is actually managed by BlackRock in very short liquidity funds. Wouldn't say there's no risk, but there is always a risk in a liquidity fund. But, these are very short-dated, short-duration assets that they're putting it into, which is managed by BlackRock. And again, what they do is they say, we take the first % that money earns, and then we aim to return 80% of anything above that to the customer. And so you look at my bank account, they pay me the princely sum of absolutely zero for having some money in that. And I've transferred some money to a Wise account for that reason, because it just means that you can earn some money by having it on deposit. And it's overnight money. They credit your account daily, unlike a bank which probably credits it monthly. And if you take any money out from that savings account as well, you lose the interest on that month.
So reading your piece on Wise, it was very clear that the founder played quite an important role. And you do see this in a lot of these long-term compounding companies. And I guess Revolut is the other company operating in this area. Again, a founder really drove it rather than the industry coming up with this solution. Is that something that you've seen across some of the compounders that you've been looking at, that actually, founder mentality is pretty important?
Yeah, that's one thing I actually specifically look for, is the companies where they have a founder-led or owner-managed, or even in the case of Goodwin, it was founded 140 years ago, so it's quite difficult to be the founder of that one. But actually, they've got 4 members on the board called Goodwin. It's not to say that all founders are great. But if you search those out, and I'll give you an example, Admiral Insurance, founded by Henry Engelhardt and David Stevens in 1993, I think it was 1st January 1993, they took their first premiums. They were very quick into being a direct insurer. So people used to go through brokers, and then they realized the power of the internet and they asked more questions. So they got better data. But you would have thought in 2008, 2009, well, everyone's got the internet. Everyone asks more questions. So what is it about Admiral that's allowed them to keep growing through 2000 and, the last decade and more, despite you think everyone being able to catch up with them? So I think that sort of founder-led mentality just allows the employees and encourages the employees to think outside the box. I mean, Mark, you've probably seen it as well.
Yeah, well, there's a US fund manager called Tom Russo who talks about, it's important to have the capacity to suffer when you're trying to grow value long term, because obviously those first few years with Wise, heavily loss-making, consuming capital, you do have to have that capacity to suffer and absorb the pain. And you talk about HSBC in the note, they tried to launch a similar product to Wise and just closed it down after a year because obviously the losses couldn't be stomached. So the great thing about being a founder is you've got an enormous capacity to suffer because you end up being so far down the rabbit hole, it has to succeed. So you've got that drive to keep going.
Doesn't it come down to the point you made earlier, Mark, about duration, and that compounding to work, you need duration. And to be Next today, you have to have been able to carry Next's business model through the challenging times that it's experienced and learn from it and come out the other side. I mean, the classic case of a founder that gives a company that sort of duration and that ability to suffer pain was Netflix, where they made the really painful transition that no journeyman CEO on a 3-month quarterly reporting cycle would ever have done, to can the DVDs by post and invest all that capital into the wing and the prayer, which it was at the time, to make Netflix a digital product, which has transformed it into a $1 trillion company or whatever it is today.
A good idea, often when it gets the zeitgeist and customers love it, they keep returning to it. And then that flywheel from the management side is like, well, customers love this. What can we do now to really give even better value to our customers over time? That's what you look for when you're talking to management. And this was your point. The people involved is so important to me and the culture that they create around it.
Talk to us a little bit more about Goodwin. It seems to be a company that, in my experience, arrived in the UK stock market without trace, but is a seriously big company with virtually no institutional sort of professional shareholders. Those who know about it love it. But as you wrote in your piece, Simon, it's been one of the UK economy's sort of great kept secrets for what sounds like over 100 years now.
140 years old. I went to the AGM up in Crewe recently, and I think it was something like the 60th AGM that they'd had. So it's been quoted for donkey's years. And it's a sort of world-class heavy engineering business for 2/3 of it, and the rest of it produces refractory powders. So it's not your typical recipe for a compounder. Come back to my point about, or Mark's point about duration and reinvesting of cash flows. It's got duration, but it has required quite a lot of reinvestment of its cash flows over time. This is a business which produces massive bits of metal. I mean, these can be up to 40 tons. They're cast, so that molten metal is poured into a sand mold. And then some of them might take 7 to 14 days just to cool down, just to put this into perspective. This is not something that is done lightly. And it's producing 29-ton boxes to hold spent nuclear waste for over 100 years. Again, that needs to be done very well. And then they're machined and bits for nuclear submarines and warships. But come back to the pivot point, 2016, the company had a big exposure to petrochemicals, and the oil price had fallen 2014 to 16. Companies like Shell and BP had previously said, we want to buy the best in class. And then the oil price falls and they say, well, actually, we can't quite afford that. Let's buy some cheaper stuff from, some low cost economy somewhere. And Goodwin finds itself in a bit of a problem. And they think to themselves, well, what can we do that no one else can do? This is the sort of the management thinking here. And this is what I really like about this business, is about the ability to think long term. And they thought, well, we can produce bits that will never be outsourced. So you'll never really outsource your nuclear cleanup boxes to some low-cost provider, because guess what? That'll be someone else's problem in 50 years' time if it goes wrong. And they also thought, well, actually, if we do more defense work, that's not going to get outsourced to the Far East for nuclear submarines, because under the Polaris Agreement, you're not even allowed to do that. And they also realized that they're the best in class around the world at what they do. So they invested heavily in their foundry in 2016 through to 2018. They also had to get all certifications for things like these nuclear cleanup boxes, which might take 7 years to get the right certification. And to produce this HY80 steel, which is used in nuclear submarines, for example, takes huge amounts of regulatory and certification. So again, that's the barrier to entry there. But now they've got themselves in a position where they're winning work from the UK MOD, from the US DOD, nuclear Sellafield, nuclear cleanup. But they've also realized that they're in such a strong position that they expect any future large capex to be entirely customer funded. I'll say that one more time, entirely customer funded. And you can do that as and when you've got something that no one else can provide.
And unusually for a compounding company, it's involved in capital-intensive activities. But as you say, if you can get your customer to pay for that investment, or substantially pay for it, you've reached a happy place, haven't you?
Again, come back to the part of culture. As I said, they've got 4 members of the 7 on the board who are all called Goodwin. The chairman and the guy who runs the foundry are brothers, and the 2 major divisional heads are both brothers. But they're all younger than Mark and I. They're all early 50s and below, but they have a real passion for investing, not for the sake of investing, but innovation. They're re-engineering a DuPont product that they think can be better than this DuPont product.
Is this the plastics?
Yeah, it's a sort of super plastic is how you talk. It's a polyimide polymer, which is very lightweight, can withstand very high temperatures up to 300 degrees, and is very hard wearing. So you use it in aeroplane engines, you use it in semiconductor fabs. When it gets heated up, it doesn't outgas toxic gases which would impact the wafers that are being made.
Sounds like it's the material that we all thought Victrex was a few years ago.
It's like that, but just a lot better and a lot more expensive. So Victrex's average cost per kilogram is something like 70 to 80 pounds a kilogram, and this might be 500 to 600 pounds a kilogram.
So it's really an interesting example of a management team who have got not just interesting ideas and ways to innovate, but the agency to do it because they are the company. I mean, the clue's in the name, you open the door.
The family owns 54%, so they are effectively in control of this. And some people say, well, I don't really want to be in a business where I'm a minority investor. The reality is you're always a minority investor in most companies. So find the companies that are really prepared to pull in the same direction as you, the shareholder, and get in line with them. And that's what I really like about this.
To come back to what you were talking about earlier, it's to pull away from the direction of the industrial consensus. I think of Tim Martin at Wetherspoon, who completely rejects the idea of conventional corporate governance. He knows how to run pub businesses, and he knows people who know how to help him run pub companies. And if you want to invest in his company, of which he is a very large shareholder, you do it his way, not the sort of considered consensual way. These sort of companies tend to rub up against the conventional forms of corporate governance, don't they? They're mavericks, maybe.
Yeah, I think that's right. But what's really striking with Goodwin is to have kept that going for so long. You think Britain, sort of the Industrial Revolution, how many of those companies from the 19th century, are still family controlled and influenced, right? Even just divorce and death. And there were so many torpedoes that stopped that process from happening, let alone, what the third generation wants to do. They want to spend the money rather than reinvest. So, really is an outstanding example of that.
And if you look at the number of shares in issue, it actually has remained the same for about the last 15 years. So again, it's not one where, management teams are awarding themselves egregious LTIPs and trying to exclude certain things from their earnings per share computations. I have a particular bugbear about management teams excluding share-based payments from their earnings per share.
Yes, I saw you write about that the other day.
Well, I just think you're trying to tell me it's a great story, and then it just sort of creates a little barrier to me wanting to invest when I start to see that you try to exclude something that really should be, in my opinion, included in the computation of earnings per share. You know, this is a transfer of wealth from owners to management, and if that's fine, as long as they're doing a great job and it's not completely egregious, but front up about it and just say, yeah, this is part of our payment. So, you know, we're going to include it in earnings per share, but to exclude it, I'm not so keen on that.
What I found is that family-controlled businesses want to suppress profits as much as possible, you know, through depreciation and through investment, because they don't like paying tax. Whereas obviously, you know, if you're a CEO looking at an LTIP over the 3 years, you want to maximize the earnings per share.
You push everything into the shop window, don't you?
Correct.
So this sort of scale economies shared is so powerful. But there are other ways of compounding, and one of them is through acquisitional compounding. But there are certain companies, I mean, Constellation Software in North America, but closer to home over the years, companies like Halma and Diploma that have made the business of acquiring other businesses the way they compound. And that's very different and not as intuitive maybe to identify. So I just want to see if we can sort of move on and talk about some of those situations.
I remember, you know, when I started my career, acquisitions had quite a negative connotation in terms of destroying shareholder value. And it was kind of the dying era of the conglomerates, you know, the Hansen, BTR, companies that just really ran out of road. And, you know, it was almost a kind of too financialized, you know, acquisitions. But since then, actually, as you said, there is a group of companies that serial acquirer is a term that's used, that have, you know, managed to grow, you know, Constellation, Halma, Diploma, Judges Scientific. But I think it's a very different philosophy to the conglomerate era. You know, it's really about providing a different form of ownership and getting scale economies rather than just banging companies together and taking out costs and creating quite a disruptive culture that usually has a time horizon. This is about providing a holding company where the acquired companies have still got a lot of autonomy. But I think the key point is that the companies that can grow in this way, they've got to be high margin, cash generative businesses that can really prosper as individual units. And, you know, the compounding effect of doing that over time and reinvesting the cash flow, as you've seen from those companies, you know, is incredibly powerful. But I think they've got to have the right culture, and you've got to have the right team at the top and a board who has got the confidence to give autonomy to the individual MDs running the individual units.
I guess it comes down to Simon's point earlier about compounding cash flow that creates money upon which you can then compound, but rather than an internal reinvestment rate of return, from the center, you're harvesting the cash to reinvest externally into identifying new similar businesses, but independently operated companies that can repeat the trick.
Yeah, I think the kind of corporate center is really focused on capital allocation. That's kind of 90% of what, and then just providing the framework for those companies to prosper individually rather than, you know, having a dominant head office dictating to subsidiaries what to do.
I think the best ones help them out, don't they, Mark? They have conferences where they get together their leading managing directors from each of the subdivisions or divisions or operating companies, and they say, okay, we've got a problem with tariffs. And someone says, well, actually, we've got a problem with tariffs, but we've done it this way. Another one says, well, we're having some supply chain issues coming out of China or Vietnam. And someone says, well, actually, I've got a great supplier in Mongolia or somewhere. And so actually, there's a real symbiosis to that.
But it's problem solving rather than direction.
Yeah.
We're helping them solve problems, but giving local autonomy. I was just looking yesterday at tracking the share price charts and the earnings growth over the long term, over the 15, 20 years or so, for companies like, we've mentioned already, Constellation Software, Halma, Diploma. You get this beautiful bottom left to top right share price going up in a broadly exponential way, and the earnings per share 1 year out forecast going up at the same sort of rate. And then look at Judges Scientific, and you might not want to come and talk about specific stocks, but they've had a few problems and it looks like it's broken down. So we don't have to talk about Judges specifically, but it just happened to be the one I looked at that looks like things aren't quite so smooth at the moment. Is that an opportunity, or is that an indication that things have gone wrong? And how do we make that decision?
It's a tricky one. And even if you look at Diploma and Halma and even Constellation, it's not sort of guaranteed, sort of bottom left to top right. And you kind of zoom in on individual periods and companies go through headwinds and downturns. I think Judges has just been operating in quite a difficult environment in terms of end markets, research, academic purchasing, Trump tariffs, lots of uncertainty. But it is still a collection of high margin businesses which generate cash, and the share count, remains gloriously unchanged. I think it's more of a phase that it's going through. But, these are still real businesses operating in the real world.
They're not immune. To come back to Mark's point there, it's a business that has generated underlying growth in each of its operating companies over 15 years. As Mark says, the external environment is tough at the moment, but that's not to say they might not try to reorientate the business a bit away from research, more towards corporate customers. That sort of pivot, as we've seen with Goodwin, will take a couple of years. I'm not saying it will happen, but I'm just saying where you have, I really respect David Ciccarell and Brad Ormsby, the finance director of that business. They've got some good operating managing directors below them who help the companies. So it's not in a terminal place. And I think Mark's right. Often these companies will go through a 2 or 3 year period of a fallow period. And then suddenly you won't be surprised if they do a couple more acquisitions, which are additive in terms of return on capital and to the underlying business. And suddenly the business starts to improve in terms of the external environment. You think, oh, well, why didn't I buy those when it had that fallow period? And I've done that before with Diploma, to be very honest with you. And it's up there at about number 3 in the all-time FTSE 350 or FTSE all-share returns over the last 20 years. Diploma, it's about number 3 or 4 from memory.
It's been amazing and relatively unsung as well. There's a demarcation out there, isn't there, between a sort of a good growth company, growth at a reasonable price type company, of which I've got a few in my portfolio. They don't have the tag quality compounder that the companies we've just been talking about have earned over the long haul. How do we find the compounders that aren't yet rated as compounders? I'll just throw a couple out there that I own in the UK right now, which are Trainline and Trustpilot, that are both, depending how you look at it, and different people have different views, I think they're quality businesses, both at a reasonable price. But they don't have the tag of the type of companies we've been talking about today. What do you think? Are there either of these or any other companies out there on your watch list that you think could assume this sort of tag given a bit of time?
Both Trainline, Trustpilot, inherently high return on equity businesses. I guess with Trainline, you've always got this kind of regulatory government transport policy sort of sword dangling. Trustpilot, I think that's a really interesting bit. I like businesses that are almost kind of intermediaries between a company and the customer. And, the company needs that intermediary to validate what it's doing. And I think they operate in a nice space there. I've been looking at some of the more serial acquirer type businesses are on my radar. So obviously the Rosebank, the Melrose team, I think that's perhaps at the early stages of something very interesting. Got Software Circle, which is a small company, Constellation software lookalike, again at an early stage. We had an IPO last year, Amcomri, which industrial acquisition vehicle. I own a company called SDI, which is a little bit smaller than Judges and has been through a bit of a cycle with a different management team, but it's sort of coming through that and, is getting back onto the path of sensible acquisitions and generating organic growth. So they're some of the companies that are on my radar at the moment.
I was struck by your question about how you find these companies, and often they're there in broad daylight. You've just got to do a bit of looking, thinking, learning, and a bit of legwork. And I'll give you a couple of examples. So if you just go after this thing and just go and have a look at the Games Workshop, for example, annual report, written in a completely different style to virtually most other annual reports. You look at the early Henry Engelhardt written annual reports by Admiral PLC. His first line of one of them is, Admiral is like a freight train going downhill, or like a snowball or something going downhill at speed or something like that. And you just think, I never seem to read that in any sort of large bank or FTSE 100 sort of company. And you take next, the attention to detail in those leads me to believe, and I can't say it's completely true, that they are written entirely by Lord Wolfson. And so if you read Goodwin's annual report, they say, we describe our business model, and the words are something to the effect of, we don't really mind if our competitors read this because they're not going to be able to do what we do, because we've got culture. And so, people say, well, what are you looking at next? And I'm always looking for the next company to buy at a low valuation. And sometimes it's about just reading an annual report, thinking, oh, they're a good set of numbers. Let's have a quick look at the annual report. And you think, oh, this is really interesting. It's just written in a different way.
Yeah. It's not been written by committee.
Exactly. And I bought Games Workshop back in 2018, I think it was, or 17, after reading one of Kev's annual reports and thinking, this is a company that I've always quite liked. I once learned read all the manual to do a sort of Dungeons and Dragons type game. But then I realized it was such a long thing that my parents and my brothers never really wanted to engage with it either. So we never played it. But it fascinated me.
So you're a repressed gamer, Simon?
I think they're called hobbyists, actually, Jeremy.
Okay.
But the answer is no. But again, that's a really interesting point that you make there, that sometimes people want to make their hobby, their activity difficult to get into, because that means that it only attracts the people who are really committed. It's like a bit like people buying a house or being a tourist. Okay, you can have tourists and they go to somewhere, they think, oh, that's quite nice, but they don't really stay. But then you have people who buy a house there and they think, I'm committed to this.
So what about the macroeconomic and market backdrop? Does that impact how you think about investing in compounders, or is it just a case of kissing lots of frogs, turning over lots of stones, looking in these unusual places to find these companies that can, whatever the conditions, can deliver this compounding effect?
It comes down to the characteristics of the companies as the starting point, trying to find companies that have got the ability to create value over time. And I almost think of the macro side of it as sometimes providing the opportunity to enter at an attractive price. We talk about Judges, and it's a good example of that dynamic at the moment. You think about a company like Ryanair, I've lost count of the numbers of opportunities you've had to buy there because it's operating in a very cyclical industry. But those downturns, are always good entry points because the underlying strategy and the compounding characteristic of the business is still strong.
Come back to Admiral Insurance. I mentioned it a couple of times. It floated in 2004, in September 2004. There's been Brexit, there's been the global financial crisis, and yet if you look over 20 years, the shares have compounded at something like 18 or 19% per annum for those 20 years it's been on the stock market. And it had a very difficult period in 2012 or 13 from memory, where they couldn't work out whether they had completely underwritten the wrong cohort of young drivers, and they had some massive smashes which caused them to have a downgrade to their earnings forecast. The big tell there, I think, was when Henry Engelhardt bought £1 million worth of shares.
It's always a good one.
I remember meeting them at the time, and it was pretty clear they didn't know themselves whether they had underwritten a bad cohort, but they did the work, and they then said to the market, no, we think actually it was genuinely an unlucky set of circumstances where we've had some really big smashes, and it was not due to our underwriting standard slipping. So, again, using the opportunity of some bad news in a fundamentally good company to buy shares cheaply.
Perhaps we could just finish on observations that you might want to share with us about how markets and perhaps fund management, the asset management industry, has changed in the period that you've been investing, either for the better or the worse.
It's mainly for the worse, I'm afraid, in terms of the UK stock market. We have been alone amongst developed economies at removing our kind of natural long-term investors from our capital markets, namely life funds and pension funds, which has been a brutal and painful and long process. But the good news is that it's happened, and it can't happen twice. So the ground that we're on now is firm ground. And, there are sort of a few signs, of an IPO pipeline emerging and, overseas investors, corporate activity. There are lots of reasons to be cheerful, I think. And what sort of Goodwin really shows me is that the stock market has a role in providing a forum for family businesses to have long-term ownership. And, we have this inheritance tax change in the UK where it's been removed from family businesses. And, when you think about when, family business is going to have to pay inheritance tax, how are they going to pay it, right? Are they going to gear the business up and pay it? Well, that's quite dangerous. Do they take a dividend out, pay income tax, and then pay the second tax? I think the solution could be to have the company listed, and whether that's in the Pisces project, which is happening, or simply just to list on the main market or AIM, that could be a solution to that dynamic. So, if I was a corporate financier, I would be trying to talk to as many of those lovely family businesses as I could for when the time comes that that's a solution that could be presented, because as we've seen with Goodwin, it's worked very well.
I refuse to get too downhearted in some ways, because it comes back to your own sort of personal circumstances and portfolio construction. I'm a person who, in my personal investments, tends to be pretty concentrated. So I don't need a huge amount of companies. So I'm not like a standard UK equity fund with 50 or 70 holdings. I'm operating often at 20, but realistically, of those 20, there's a high concentration in the top 5. And so for me, I only need to find one every couple of years that is a brilliant opportunity to invest. But that's on a personal basis. I still think you can, even on having 20 companies, you can still find some great compounders in the UK. You just got to open your eyes and be selective. Sometimes we will settle for third or fourth best, whereas waiting for the opportunity, having some cash on hand for that opportunity when there's a big profit warning to start building our position, or markets are in free fall to start building your position. I think having cash is a bit underrated, actually. People say, it's a big cash drag as an institutional fund manager because you've got...
You mean you're not all in on gold? I'm disappointed.
In hindsight, I wish I had.
Interesting perspective, though. And I think what you're highlighting there is something that guy I interviewed a few months ago called David Dredge opened my eyes to, is that I know the value is subjective, but his thesis is the risk is subjective. And it is totally subjective. It totally depends on your own personal circumstances. Your risk profile is different to my risk profile, to anybody else's risk profile. So the risk that we have, inflation higher than expected, the impact of that is totally dependent on your starting position.
Buffett's original partnership, I think, had at one point 60% of their assets in American Express, because they just said, this is the best single opportunity I can find. And it comes back to that phrase that if you got all your eggs in one basket, you better watch that basket pretty carefully.
Exactly, yeah. Which is what these founders do for us.
Yeah, I mean, these founders, they're all in on one investment, effectively.
Yeah, they look after that basket, don't they?
Yeah.
And we're taking advantage of that in many ways. You just got to get the right basket and the right person looking after it.
And that is exactly the point, in my opinion, about being aligned with management, being selective. You don't have to invest your money. It sounds good, but you've got more time than you think. If you're compounding over 20 years, or hoping to wait 6 months because you just need a bit more time to really make sure through the actions that you see of that management team that they really are aligned with you through actions, not just words, is really important, because you can repent at leisure, as they say.
I think that's right. And I think you also sort of need to have the fund managers who have got the capacity to suffer and have got the bandwidth and the ability to invest in a similar way, right? Rather than, the industrialization of markets, ETFs, indexation, has been terrible, I think, for kind of long-term returns. But I think the managers that are remaining and have stuck to their approach and are prepared to run concentrated portfolios, they're the people to back.
Yes, very good. Thank you so much. for sharing your time, and look forward to catching up sometime in the near future.
Thanks, Jeremy.
Thanks, Jeremy.
Brought to you by Progressive Equity.